Swayam Prabha. Digital India. Educated India.
We will take one or two more examples. I have taken two more exercise, that is from the textbook what I have prescribed, chapter 11, 11.4 and 11.5 from the textbook that I have prescribed. I am taking two more examples and we are working on that. One is a direct method and is an indirect method. Let us start with the direct and then let us go to the indirect method. I think that will suffice the cash flows. Again, I've picked up the problems from the prescribed textbook. Let us start with cash flow again. We will start with the indirect method first and then let us go to the direct method. We will start, there are two problems I have. One is a problem using indirect method and is a problem using direct method. Let us start with the problem using indirect method. Now I said that there is a problem, cash flow problem. Lorry Crump owns a small trucking company or trucking operation. The bookkeeper presented Crump with the following income statements and balance sheets for the year 2010 and 2009. The revenues, income statement, revenue, depreciation, fuel, driver salary. I am sorry, there is a false typo out there. It is not salaries, it is salaries out there. Taxes and licenses, repairs, miscellaneous, and then there is a loss. Income is a loss in 11,000 in 2010 and profit in 2009. And there is a balance sheet, there is a cash balance, fixed accounts receivable, fixed assets out there, and then all the payable balances are there. But Crump does not understand how the company can be 17,600 ahead of the last year in terms of cash. As you see, cash last year was 4,400, this year is 22,000, that means 17,600 more, but making a loss of 11,000. They made a loss of 11,000 but cash balance is higher. He wants to know how. That is where they asked you to prepare what is called as the indirect method for cash flow statement, because this is all what he asked. The balance sheet for 2 years and then the income statement out there. Income statement for 2 years is given but 1 year is sufficient for balance sheet for 2 years and then the income statement. Then you got to figure out what is the cash is out there. Let us try and see if we can solve it. Before that, let me close this Lone Pine Cafe, what we worked on. Now I got this cash flow statement for Lorry Crump for the year 2010. We say net loss 11,000. Net loss is 11,000 for the year 2010, and I have clearly taken that net loss for the year 2010 out there. Now let us go to the cash flow from operations. The cash flow from operations, if you actually look at this particular problem, there is 11,000 loss is arrived at after deducting depreciation of 26,400. Depreciation is a non-cash outflow. It is a non-cash expenditure. So they have deducted a depreciation of 26,400 and then arrived at a loss of 11,000. Let us quietly add back that depreciation out there. Let us quietly add back that depreciation out this case to know what is the cash balance. That is, now add depreciation out there. 26,400. Now that is what first thing we have got. Now we go to the balance sheet. out there. When I go to the balance sheet out here, I see that accounts payable last year was 22,000, this year it has become 30,800, and there is a revenue, there is a there are purchases and so on and so forth out there. Accounts payable last year was accounts payable last year out there was 22,000, this year is 30,800, and normally it is a trucking company. When I say trucking company, all the payables will be related to your fuel, because if you look at salaries, there is other accrual out there. So normally fuel is the core operating aspect out there. So your payables are related to your normally what do you call it as to fuel out. So we see that fuel expenditure charged is 17,000, accrued is 77,000 as per P&L. but I am yet to pay 30,800. Last year I was to pay 22,000. Let us see how much of cash has actually gone out. We are not worried about to which year it pertains. How much of cash has gone out. Let us do the calculations out there. Let me go out here. Let us see current year's fuel purchase or the fuel expenditure charged to P&L is 77,000. What was the amount that was due at the end of last year? That is, add the expenditure, add the what is the amount? Add the what do you call payable, add the payable of the last year. How much is the payable of the last year? We see this in this balance sheet. The payable of the last year is 22,000. I am adding that payable. So, what is the total amount that is payable out there? The total amount that is payable, that is total amount you are liable to pay. Total amount you are liable to pay is 99,000. Is total amount, that is one is liable to pay, is nothing but 99,000 out here. How much is still due? How much is still due? That is less due at the end of the year. Current year. What is the due amount due at the end of the current year? As you can see in the balance sheet out here, it is 30,800. I just say 30,800 out there. So, what is the amount that is actually paid? The amount that is actually paid is, this is the amount that is actually paid. Amount actually paid. Amount actually paid is 68,200. So, what have you charged in the P&L? 77,000. And then you have arrived at a loss of 11,000. You have charged 77,000 and then arrived at a loss of 11,000. Whereas, how much have you paid? Whereas, how much have you paid in the? You have paid only 68,200. That is, you have overcharged 8,800. Am I with you on this? You have overcharged 8,800. Cash has not gone out to the extent of 8,800. So, what happens? I add back accounts payable, difference in accounts payable. Difference in accounts payable. That is what it is. It is 8,800. I add back because overcharged. So, and then you have overcharged is 77,000. Whereas, what is the cash gone out? Cash gone out is 68,200. So, I am adding back this 8,800. Next, I go to the liability side of the balance sheet out there, and then I see that accounts payable over. There is something called accrued salary. Salaries for the year 44,000. Beginning of the year 5,000. End of the year 8,800. How much have you paid? Let us do the same thing out here. That is accrued salaries as per the P&L is nothing but 44,000. Salaries due, add salaries due at the beginning of the year. Add salaries due at the beginning of the year. You go back to the balance sheet. What is the salaries due at the beginning of the year? 5,500. That is end of the last year. 5,500. So, what is the total salaries due out there? The total salaries due. Total salaries due is 49,500. What is the salaries due end of the year? Salaries due at the end of the year, that is, you are still have to pay 8,800. You still have to pay 8,800 out there. You still have to pay 8,800. Salaries due at the end of the year, 8,800. What is the actual amount of cash that has gone out? The actual cash paid for salaries. The actual cash paid for salaries is only what is called as 40,700. How much have you charged? 44,000. So what is the excess charge? 3,300. Well, you have charged 44,000 in the P&L and arrived at a loss of 11,000. But what is the cash that has gone out? Only 40,700. So what is called as add difference in driver salary due. What is the amount of difference? 3,300 is the amount of difference out there. Next, after driver salary, we see that in the liability side of the balance sheet, we see that there is something called other accrual. There is something called other accruals. There is something what is called as other accruals out there. That is a liability. Now let us look at the other accruals out here. Now let me look at the other accrual. I am taking the other accrual as what is called as pertaining to miscellaneous expenditures. Other miscellaneous. Let us look at this. What is the miscellaneous expenditure as per the P&L 2200? That is what we see in the P&L out there. In the P&L, the miscellaneous expenditure charge is 2200. What was add? That was add the miscellaneous expenditure due at the beginning of the year. Add the miscellaneous expenditure that was due at the beginning of the year. At the beginning of the year, if you see in the balance sheet, it says other accruals due is about 1100 out there. That was due out there, 1100. That means, what is the total miscellaneous expenditure due? Total miscellaneous expenditure due is 3,300. What is due at the end of the year less what is due at the end of the year? End of the year. What is the miscellaneous expenditure at the end of the year is 3,300 out there. What is the miscellaneous expenditure at the end of the year? 3,300. So, what is the basically if you look at what is the actual miscellaneous expenditure paid in this particular case, it is this minus this, it is 0. So, what happens? What is the miscellaneous expenditure charge in P&L? 2,200 and then arrived at a loss of 11,000. What is the actual cash that has gone out? 0. So, what happens? Add difference in miscellaneous expenditure is about 2,200 out there. Now that all the payables, all the liabilities part of it over, long term debt, let us not worry about it. It is to do with investing activity. Capital is to do with investing activity. So, let us not worry about that. Now, let us go to the asset side. Leave out cash. Let us look at receivables. Last year receivable was 26,400. This year receivable is only 8,800 in this case. Whereas, if I look at receivables, what is the revenue? Revenue is 191,000 in this particular case. So, let us look at this. Let us say revenue as per P&L 1,91,400. What is the receivable? Add receivable at the beginning of the year. Add receivable at the beginning of the year. What is the receivable at the beginning of the year? 26,400. You can check out here 26,400. What is the total amount that I am eligible to get? The total amount that I am eligible to receive. Total amount eligible to receive is 22,17,800. What is this? I will say less amount receivable at the end of the year. At the end of the year, what is the amount receivable at the end of the year? 8,800 is receivable at the end of the year. 8,800 is receivable at the end of the year. That means, what is the actual amount received? The actual amount received during the year is 2,09,000 out there. You have taken how much in the revenue? 1,91,400 and then arrived at a loss of 11,000. What is the amount received? 2,09,000. So what is the difference? That means difference between actual receipt and what is charged out there. That means you have basically charged only what do you call it as 1,91,000 out there, whereas you have received 2,09,000. That means what happens? I add the excess amount received. I add the excess amount received in compared to the revenue. That is difference in what is called as accounts receivable. What is the amount out there? The amount that is difference in excess amount receivable is 17,600. That means I have received 17,600 more as compared to the revenue. Revenue I have taken something and arrived at a loss. I received 17,600 more. I have got it. Now next, I go to the balance sheet. We go to investing activities. We go to the total asset, net fixed assets. What is the net fixed asset? Last year was 2,24,400. This year what is it? 1,98,000. Let us see this. Last year what was it? 2,28,400 out there. 2,24,400. Current year what is it? It is only about 1,98,000. That means what is the difference? Difference is so much. It has reduced by 26,400 because you could have either sold the asset. If you have sold the asset, then cash inflow because of an investing activity here. Whereas this 26,400 matches exactly with the depreciation amount that is charged. That means the asset value is reduced not because of a sale that you have made. It is because of a depreciation, the asset value is reduced. Depreciation is non-cash expenditure. So, as far as the cash flow statement is concerned, my cash flow from investing is blob 0. Now, I go to the cash flow from financing activity out there. I again go back to my balance sheet. I look at all this. I look at the long-term debt. I look at the capital and the long-term debt. These are the two things which are pertaining to investing activity. And there is no interest here. If I look at this, in this particular case, I see that the long term debt was 1,29,800 last year. This year it has become 1,100,000. 1,29,800. It was 1,29,800 and this year it is 1,100,000 out there. So what is the difference? Difference is 29,700 is the difference. That means why has it reduced? You would have ideally paid back. You would have ideally paid back that money. That is where it has reduced. Otherwise, nobody is going to give you a holiday. Why does it reduce? Unless you repay, it doesn't reduce. When you repay, what happens? Cash outflow, long-term debt, repaid. What is the cash outflow? Minus 29,700 out there. That is a cash outflow that has occurred. Now let us go back to the balance sheet. Sir, equity has also reduced. Crump's capital. So have you paid back? Let us see. 96,800 was the last year's Crump's capital. 96,800. This year the Crump's capital out there has reduced to 85,800. What is the difference? Let us see what is the difference out there. Difference is 11,000. What is the loss you have incurred? Loss incurred is 11,000. 96,800 was the capital last year minus that 11,000 capital. 11,000 loss gives you 85,800 out there. So that reduction is because of the loss, not because of repayment of capital that has happened. So let's go back to the cash flow statement. So what happens? This is the cash flow from operation. This is the cash flow from investing. So total cash flow for the entire year is 17,600 out there. Now I add the opening balance. Opening balance of cash. What is the opening balance of cash out there? Opening balance of cash is 4,400 out there. Opening balance of cash is 4,400 out there. Now, if I add the opening cash balance of 4,400 plus the total cash that is generated in the year 2010, what is my closing cash balance? My closing cash balance is 22,000, which matches exactly with the figure what you have out there. So, what have I done in this case? I have got my P&L, I got my balance sheets, and I have basically used the P&L and balance sheet together and arrived at a cash flow statement of indirect method. So, now if I have to explain in this particular case, the cash balance has gone up by what, 17,600, whereas I have made a loss. How has the cash balance gone up by 17,600? Because you have not paid, because of depreciation, yes, because you have not paid so many expenditures out there, and because you have received last year's due, and because of that your cash balance has gone up, and you have paid to long term repaid your cash balance. How your cash balance has gone up? You have got the explanation here, right? So, this finishes the indirect method. Now, let us look at the next problem. After Lorry Crump, I said Lorry Crump problem, you can take a look at it. Now, there is one more question. Exercise 11.5, same textbook. 11.5, there is one more cash flow problem that says direct method. They have given you all the balances. Prepare a direct method out there. Let us make it very simple. Now, we see this. They see the problem on the screen. There is a direct method, simple straight direct method out there. You don't have balance sheets, you have given all the cash balances he has given, so we are doing it a simple direct method out there. With this we will finish the cash flow statement. With the completion of this problem, I will be finishing the three basic financial statements: income statement or the P&L or the revenue and expenditure statement, however you want to call it, the balance sheets, and then the cash flow statement. All these three financial statements, basically the input would be complete out there. In the next class, we will start with analysis of the financial statements. How do you analyze the financial statement? How do you prepare the ratios? How do you analyze the financial statements out there? That we will worry about it in the next class. Now, let us focus on this. It says, the owner of a small business has asked you to prepare a statement that will show him where his firm's cash came from and how it was utilized or used this year. He gives you the following information based on the cash account in his general ledger, the way he keeps his books: collection from accounts receivable, interest on savings, sale of old machine, cash sales, payment to vendors, cash purchases, supplies, inventory, down payment for new truck, rent, utility, interest, miscellaneous, part-time help and part-time debt, payment of redundant debt, etc. And then they have given you a lot of additional information out there. Now, let us go back and prepare what is called as the cash flow statement for them. Now, when to prepare the cash flow statement, I have got my Excel sheet ready out here in this particular case, and then my Excel sheet says this. Same thing, operating cash flows, investing cash flows, financing cash flows. Now, I have written all these things. What is all these things? Don't worry, we will go step by step out there. First thing, what is the cash that is received from customers? Inflow. Direct method. Please note, this is a direct method. I may write direct method. What is the cash that I have received from customers out there? Now, let us go back to the problem. Collection 34,500, credit sale 27,600. So, what happens? What is the cash received from customer? 34,500 plus 27,600 out there. That is the cash that I have received from customers. Yes, that is the cash that I have received from customers. Let me take out the decimals out there. Okay. Now, operating cash payments. How much have I paid for my operations? I will go back to this. All this. Let us also see cash operating expenditure total 54,165. They have given out there. But let us look at the calculations out there, including cost of sales, supply, rent, utility, part-time help and other miscellaneous expenditures. Let us go back and try and see if we can calculate it out here. I am just going to explain this whole thing out here. Let us see cash purchase of supplies, cash for supplies. How much is it? It is about $345. Next, purchase, what do you call it as? Cash purchase of, now it is cash purchase of inventory, cash for inventory. How much is it? It is about 17,250. Next, what is down payment of new truck? It is what is investing, so we will not worry about it. Rent payment. Rent payment, how much is it? 8,625. Next, utilities. Utilities, what happens? It is 2070. Next, interest payment. Not interest payment is to do with cash outflow because of a financing. Other miscellaneous expenditure. Expenditure, what is it? 1725. Miscellaneous expenditure 1725. Then what happens? After miscellaneous payment of debt, we don't worry. Then there is something called part-time help. What is the part-time help? 6900. Have I missed out anything? Yes, payment to vendor accounts. There is something called payment to vendor account. Payment to vendors 17,250. Now let us go back and read the other thing. Sales, we have already accounted for cash received from customers. Account receivable decreased by 690. In this particular case, we have already taken a collection from accounts receivable we have considered, so that is considered. Then let us look this. Cash operating balances totaled so much, we will check the balance. Accounts payable decreased by 2760, we have say payment to vendor accounts accounted for. Inventory balance remained constant throughout the year, not worried. Depreciation was so much, we are not worried because we are not preparing from the P&L, prepare a cash flow statement. Let us look at the total of this. 54,165, and you can actually see this cash operating balances total 54,165. We have got exactly the same figure. So what is my operating cash flows? My operating cash flows is I have got cash received, then my operating cash flows I have to reduce this. So what I have to reduce this? This is what is my reduce this. Then what is my operating cash flow? My operating cash flows is 57935. So let me say less payments. Operating cash payments. Now let us look at the other investing activities out. When I go to my investing activity, I see that there is a sale of old machine 3105. That means there is a cash that has come on to me. Then I see in the payment what is called down payment for a new truck 3440. That is cash gone out. Then investing activity, what is called as interest on savings account, that is received, that is again cash inflow for me. What is the net cash flow for investing activity? Blob. Now I go to the financing activity. It says repayment of debt, payment of debt 3450. Interest paid, interest payment minus 1035, interest paid. So cash flow from financing activity is also very clear. So what is the net cash flow from all the activities? Net cash flow from all the activities, cash flow from operations plus cash flow from investing plus cash flow from financing activity is the net cash flow from operations. What is the cash at the beginning of the year out there? Is there any detail on the cash at the beginning of the year? Is there any detail on the cash at the beginning of the year?
3450.
There is.
Balance at beginning of year 3450.
Where is it? Oh yeah. Where is it? It says, is there anything out there? Yes, it says balance at the beginning of the year 3450. Now what is the balance at the beginning of the year 3450? Now what happens? What should be the balance at the end of the year? 6900. If I just go back, it says balance at the end of the year 6900. All that I have done is I have classified into operating, investing and financing activity. This finishes all the three basic financial statements, the basic teaching part of it: income statement, balance sheets, and the cash flow statement. Now in the next session, we will start with analysis of financial statement. Thank you.